Let's talk about upfront MIP, UFIMP, upfront mortgage insurance premiums. What is it and when does it exist and why does it exist? So, just to be very clear, most of what we're going to talk about is government backed loans. That means like VA loans, FHA, USDA. Those all have some form of an upfront MIP. Now, they're going to call them different things, but fundamentally it's the same. Now, I also want to make sure it's clear that conventional, meaning non government loans, conventional loans can also have upfront MIP. The difference is on the conventional side of the fence, that's optional, meaning a borrower can choose, a homeowner, whether you're refinancing or buying a home, you can opt to have, you can elect to have the upfront, whereas these other programs, it is mandatory. So what is it? So mortgage insurance in general. So let's just use MI as the generic umbrella. That's the umbrella term here. So whether it's MIP, PMI, whatever you want to call it, right? Basically, essentially what it is insurance that says if a homeowner gets foreclosed on, every month this homeowner pays a part of their mortgage, some sort of like mortgage insurance that says if they get foreclosed on, the mortgage lender is going to be made whole. So on the conventional side of the fence, let's go over here, the Fannie Mae, Freddie Mac type stuff, on the mortgage insurance, the private mortgage insurance, the PMI, says that if they get foreclosed on, some MI company, and there's 5 or 6 really big ones that are in the industry, they sell us the insurance. The home buyer or the homeowner pays insurance each month as part of their payment until they hit that 20% equity position, and then it can go away. That's kind of the generic rule, right? So that's mortgage insurance as you know it. Front means that a buyer can say, man, I don't like the idea of paying that monthly. Can I just pay it all up front and be done with it? And usually that equates to about 3.5 to 4 years up front. They can vary, but I'd say in general, whatever that monthly piece is, let's say it's $100 a month. So $100 over 4 years is $4,800. So if a homeowner says on the conventional side, man, I don't like that. Let's pay this all up front. You can pay the upfront MIP or PMI. They can pay $4,800 at closing and be done and have it as part of their monthly payment. There are good reasons. It's not super common. There can be good reasons. Again, it's just, let's talk through it. Call the mortgage market team. We'll make sure it's the right option. That's what upfront mortgage insurance is on the conventional side. The government side, let's talk FHA, for example. FHA is mandatory. You're paying that thing whether you like it or not. So that's the part where on the government side, FHA is going to charge it. That's the upfront MIP. It can vary, every while they'll change it. 1.75, like almost 2%, but not quite. 1.75% is what it is. It may change, after you make this video, who knows, and next year they change it. But just keep in mind, it's a healthy amount. But again, it makes sure that if the trade-off is that the lenders will give a better rate for FHA because they know that if they get foreclosed on, it's there with all this, slush fund money from mortgage insurance premiums to make them whole. So yes, on FHA, there's still a monthly component as well. The reality is that's the upfront piece. For VA, they call it a funding fee. And again, that can vary based on your down payment and the loan term you're doing, but it can be 2 to 3%. Depends on, again, what you're doing, and the numbers can change and get tweaked year over year, and also based on what I just said. But that's a big number. The good news, there's nothing monthly with VA. So the veterans are good on that, but they do have to pay this upfront funding fee. There is a way to where if they have some disability to reduce or eliminate that upfront funding fee altogether. While technically it's not upfront MIP, it is, right? It's the same thing where they're paying into VA, putting it in this big old piggy bank that says if anybody ever gets foreclosed on, the VA is going to make sure that the lender's made whole. And then lastly, USDA, they call that a guarantee fee. And again, that can range, but I'd say generically speaking, let's call it 2%. Again, it can change and tweak over time and laws and whatever they do. And they got a reduced monthly portion component as well, but it's upfront, same purpose. Somebody buy a USDA loan, they get foreclosed on, whether that fee is 1.5 or 3 or whatever they're going to charge. They're all kind of around that 2 to 3% for the upfront piece on the government side. So again, upfront MIP, can't avoid it if you're doing the government stuff. Again, if you're a vet with disability, you can. But ultimately, it's going to be there. And it's just to make sure that we as lenders are protected and get your money back. But the exchanges, you typically get a better rate doing those government programs because of it. Hopefully that answers your questions about upfront MIP. If not, the Mortgage Mark team is certainly here to field anything that I forgot or add any color or insight behind something I accidentally neglected. Again, conventional, you can do it. You can also do what's called split MI, where you pay a little upfront, a little each month. So there's a bunch of different ways, and that's optional. So if you have questions, reach out. Which one's right? You can't just say this one's always the right way. Everybody's going to be different. Scenarios are different. What you need and want's different. Call the Mortgage Mark team. We are certainly to answer any questions you have. And just remember, when you think mortgage,